Can helping your own child cost you thousands of dollars in taxes and potentially deny you healthcare when you need it most? That sounds impossible, but it happens more often than you'd think, and the people it happens to aren't careless. They're loving parents who did exactly what any good parent would do. They helped their kids when things got hard, and they had no idea the IRS had rules about it. Stay with me, because if you've ever given money to your children or grandchildren, what you're about to learn could save you from a very costly mistake. Let's understand it through the story of Margaret. Margaret is a 64-year-old retired school administrator from Ohio. Widowed at 61, she has $340,000 in a traditional IRA, a modest pension, and $85,000 in savings. By almost every measure, she had done everything right. Her daughter, Diane, is 38, a single mother of two going through a rough stretch. Divorce, job changes, rising rent. Margaret never thought twice about helping. No formal loans, no written agreements. Just a Venmo payment here, a check there, a little extra cash at Christmas. Over 3 years, she gave Diane somewhere between $28,000 and $35,000 total. To Margaret, this was simply being a mother. To the IRS, it was something else entirely. None of the individual amounts were enormous. The largest single transfer was $11,000 to help Diane cover a security deposit and first month's rent. Margaret's reasoning was straightforward. It was her money. She earned it. She had every right to give it to her own daughter. And she'd heard years ago that you could give up to $10,000 a year without any tax consequences. So she assumed she was fine. Nobody at the bank flagged anything. No form arrived in the mail. It felt like a private family matter. The problem was, the rules weren't what she remembered, and they hadn't been for a long time. When Margaret sat down with a new tax preparer, he asked a question she wasn't expecting. Did you make any significant financial gifts to family members in the last few years? She mentioned the payments to Diane, casually, the way you'd mention buying someone lunch.
He asked her to walk through the amounts year by year. 2021, around $9,500. 2022, around $18,200. 2023, around $19,800.
He explained that the annual gift tax exclusion was $15,000 in 2021, $16,000 in 2022, and $17,000 in 2023. Margaret had exceeded the limit in 2 of those 3 years, not by enormous amounts, but enough to require a filing she had never made. Then he asked a question that made her stomach drop. Have you thought about what happens if you ever need Medicaid to cover long-term care? She hadn't. These transfers, he said, could affect your eligibility. There are 2 separate rules Margaret had unknowingly run into, and both of them matter enormously for anyone who helps family members financially. The first is the IRS annual gift tax exclusion. In 2024, you can give up to $18,000 to any one person in a single year without filing anything. Give more than that, and you are required to file IRS Form 709. Here is what most people get wrong. Filing Form 709 does not mean you owe taxes. It simply reports the gift against your lifetime exemption, which in 2024 is $13.61 million. Most people will never owe actual gift tax, but they are still required to file, and failing to do so creates a reporting violation that can surface at the worst possible time. The second rule is the Medicaid 5-year lookback. If you ever apply for Medicaid to cover long-term care, nursing home, assisted living, memory care, the government reviews every financial transfer you made in the previous 5 years. Any gift, any informal payment, anything that wasn't exchanged for fair market value. If transfers are found during that window, Medicaid can impose a penalty period, a stretch of time during which it will not pay for your care even if you have nothing left. The penalty is calculated by dividing your total gifts by the average monthly cost of nursing home care in your state. For Margaret, $35,000 in transfers could mean a 5-month gap in coverage at a time when she has no other way to pay. Here is why so many people get this wrong. The $10,000 myth is deeply embedded in American culture. That limit existed decades ago. It has been adjusted for inflation many times since. Today, it's $18,000. But the old number lives on in dinner table conversations and assumptions that were formed years ago and never updated. The second reason people miss this is that nothing happens immediately. No bank alert, no IRS warning. The consequences appear later, during an audit, during a state settlement, or during a Medicaid application at one of the most vulnerable moments of your life. This affects any parent or grandparent who gives more than $18,000 per year to one person, pays a child's rent, mortgage, or car payment directly, transfers money informally through Venmo, Zelle, or cash without documentation, or co-signs a loan and then makes payments on the child's behalf. Every one of those situations can be treated as a gift under IRS rules, and the transfer under Medicaid rules. Many parents also believe that paying a bill directly rather than handing over cash avoids the issue. In most cases, it does not. Rent, groceries, and car payments paid directly on behalf of a child still count as gifts. However, there is one powerful exception almost no one uses intentionally. Direct payments made to an educational institution for tuition or directly to a medical provider for medical expenses are completely exempt from gift tax, with no dollar limit attached. You could pay $50,000 directly to a university for your grandchild's tuition and file nothing. That one strategy alone can allow families to transfer significant wealth across generations without any tax consequence at all. Here is what you need to do. First, know the $18,000 annual exclusion and track your giving each year. If you're married, you and your spouse can each give $18,000 to the same person, $36,000 total to one child with no paperwork required. This is called gift splitting, and it immediately doubles your giving capacity. Second, if you exceeded the limit in prior years, do not panic, but do act. You can file a late Form 709 for previous years. There is typically no penalty for late filing when no actual tax is owed, which applies to most people under the lifetime exemption. Consult a tax professional to confirm your situation. Third, if you are within 5 years of potentially needing Medicaid, stop making informal transfers now. The lookback window is unforgiving, and even loving, well-intentioned gifts can result in a penalty that leaves you without coverage when you need it most. Fourth, use direct tuition and medical payments exemptions strategically. Pay those expenses directly to the institution or provider, and you avoid gift tax entirely with no dollar limit attached. And fifth, document everything. Every transfer to a family member should have a record, the date, the amount, and the purpose. That documentation protects you during an estate settlement or Medicaid review. And sixth, speak to a tax professional or elder law attorney. One conversation with the right person can save you from years of avoidable consequences. For Margaret, the story did not end in disaster. The amount she had exceeded the exclusion by were modest, and her preparer helped her file late Form 709 returns for the 2 affected years. Because her lifetime gifts were well below the federal exemption, she owed no actual tax. The Medicaid issue required more careful planning. She met with an elder law attorney who helped her understand the look-back risk and build a strategy for any future giving that would protect both her finances and her eligibility. Margaret still helps her daughter, she still will, but now she does it the right way, with a clear understanding of the limits, the exemptions, and the consequences of every decision she makes. Generosity without knowledge is not just risky for you, it can ultimately hurt the very people you're trying to help. Here is what to take away from this. The IRS annual gift tax exclusion is $18,000 per person in 2024. Exceeding that limit requires filing Form 709 even if you owe no tax. Medicaid's 5-year lookback can turn years of family giving into a penalty that denies you coverage care when you need it most. And there are smart IRS-approved ways to give more, including gift splitting with a spouse and making direct tuition or medical payments with no dollar limit attached. Your action checklist. Know the $18,000 limit and track every gift. File a late Form 709 if needed with help from a tax professional. Talk to an elder law attorney if you are in your 60s or older and still making transfers to family. Use direct tuition and medical payments as your primary tax-free giving strategy. And document every transfer with the date, amount, and purpose. If this video helped you, share it with a parent or grandparent who needs to hear it. And subscribe for more personal finance education every week.